Scott Ladner is with us, Chief Investment Officer at Horizon Investments. Thank you for being with us. Should we start with what's going on with New York Community Bank? I mean, are we worried about the trickle effect for commercial real estate in particular? This is what we saw last March.
It is, and so like the timing, the timing is a little bit challenging, but we do think this is probably an idiosyncratic thing. I mean, the troubles of commercial real estate are pretty well known. Janet Yellen, in fact, was asked about it yesterday in her congressional testimony. I think her answer was pretty telling. I mean, she was kind of off the cuff in her response, and she said, "Yes, listen, we think that there's going to be some more failures. We think there's probably going to be a couple more firms that are challenged, but we don't think this is systemic, and we also don't think it's systemic at Horizon. The fact of the matter is that commercial real estate comes with a huge equity cushion. If you want to buy a $10 million building, you need to show up with $4 million in cash to start with. And so the banks, that hold these mortgages, and hold these notes, there'll probably be some that are going to be challenged, but it's probably not going to be enough to cascade and really affect the entirety of the financial system.
Would you be interested in buying regional banks? As an investor, are you interested in that group, or you stay away from that group?
We think it probably makes a little bit of sense to stay away for just a little bit longer. Unfortunately, the game theory part of this is you shoot first and ask questions later, right? And so the person that panics first wins if there is going to be a really serious problem. And so if somebody's willing to do the work on individual names and figure out that this bank is going to be solid, that bank's going to be solid, probably better. I probably wouldn't play this one through an ETF structure.
Understood. So what are you thinking about the Fed these days?
We had thought that they were going to start in March.
Really?
I think Mr. Powell has disabused us of all of that, and so May or June. I'm not really sure it matters that much whether it's May or June where they start, but it's fairly clear they need to start lowering rates. They don't want to have conditions be even more even tighter than they need to be. When we have a growth that is slowing down some, employment is still really strong. But they all know that these things act with lags, and so why would they need to keep financial conditions even increasingly tighter as things are starting to slow down? We don't think that they're going to want to do that. So they will probably start second half of the year, and that's probably going to be the time where we want to play some of the small caps, some of the broadening aspects of things.
So not concerned about inflation coming back, really?
No, certainly not over the next 6 months. Now the fly in that ointment though is going to be the revisions of CPI methodology we're going to get on Friday morning.
Yeah, Friday.
Right. So Governor Waller said that this matters to him. I'm not sure why it should matter that much, but if he says it matters, then it probably does matter. And so this is something that we're going to be watching. But at the end of the day, like the path of inflation is pretty obviously down. We have goods deflation. We have AI and technological progress that's going to push prices down across the board everywhere. So we think services is coming down, and we all know the story is for housing over the next 6 months based on more real-time data. So the inflation picture for us is pretty well understood. I think it's fairly well understood at the Fed as well. We just think they want to wait a little bit longer.
Right, understood. I mean, and what about the economy and any other things that we may be leaving out that you're watching closely?
We think that one thing from a framework standpoint, just from a bigger picture standpoint, one thing that folks generally got confused about over the last year to 18 months was thinking that we're in a traditional business cycle. And so, the calls for recession have been rampant for a very long time, all of last year. Everybody thought a recession was around the corner. And that's because these leading indicators that always preceded a recession were flagging. Things like the SLUs, things like bank lending, things like inverted yield curve, like all these things that always precede a recession, were signaling that a recession is around the corner. But the problem is those things only work if you're actually in a business cycle. With the ups and the downs. And we think what the better framework for understanding this economy over the last 18 months and probably for the next 18 months is more of like a war and then a war recovery. And that's with massive fiscal spending, with supply chain disruptions, with labor market disruptions, all the things you get in a war, you got with COVID. As those things normalize, which they have been, that doesn't necessarily mean you have to have a recession. It's just not this sine wave thing that we're used to in a business cycle. It's more of a war and war recovery. And we think that framework is going to give a lot of clarity to folks over the coming year.
So now for investors, I'd love to hear your advice. I know you talk about the consumer resiliency. You don't seem to be particularly concerned about consumer debt and credit card balances, money supply. So you noted a few ways to position a portfolio. You looked at some T-bills, or getting them out of T-bills and cash should be a priority. So what should they be putting their money to work?
So we do like U.S. stocks better than international stocks, with the exception of Japan right now.
Okay.
Japan for us is fairly interesting. U.S., look, it's kind of boring. it's still tech. It is still the top of the market. Small caps will have their day in the sun, but it's probably not in the first quarter. Probably a second quarter story for us. But in terms of in terms of just broad equity markets, we think you just need to be invested. We think you probably lean into the U.S., lean into Japan. You still got to stay away from China because it's still a disaster. But the outside of those, we think you can be kind of lazy with it for right now, and just sort of pick the top of the market stuff, pick the Japanese stuff, and let it ride for the next couple months.
Right. All right. So you have tech on there. Okay. Scott Ladner, good to see you until the next quarter, and then we'll regroup. Good to see you, Scott Ladner of Horizon Investments. Thank you, Scott Ladner.